Have you ever wondered what it would be like to not worry about money? To have the freedom to do what you want, when you want? That's the essence of financial freedom. It's not about being rich, but about having control over your finances. And the first step to gaining this control is understanding investments. In this video, we will delve into different investment strategies, each with its own potential to help you achieve your financial goals. So let's dive into these strategies and take the first step towards financial freedom. Before we start investing, it's crucial to understand the basics. So what exactly are these basics? Let's start with stocks. When you buy a company's stock, you're essentially buying a small piece of that company. You become a shareholder, sharing in the company's success as well as its potential losses. Bonds, on the other hand, are like IOUs. When you purchase a bond, you're lending money to a company or government. In return, they agree to pay you back with interest over a specific period. Next up are mutual funds. These are investment vehicles that pool money from multiple investors to buy a diversified mix of stocks, bonds, or other assets. They are managed by professional fund managers who try to create growth or income for the fund's investors. And then we have exchange-traded funds, or ETFs. These are similar to mutual funds, but they trade like stocks on an exchange. This means you can buy and sell ETFs throughout the day, just like you would with individual stocks. Now, investing isn't just about buying and selling, it's about understanding what you're investing in. This is where research and knowledge come in. You need to understand the company or asset you're investing in, its market position and potential risks. This knowledge is critical in making informed investment decisions. And remember, every investment carries some level of risk. The stock market can be volatile, bond prices can fluctuate, and even the most stable mutual funds can experience downturns. This is why it's essential to diversify your portfolio, which we'll discuss in more detail in our next scene. Investing can seem complex, but breaking it down into these basic concepts helps to demystify the process. It's like building a house. You wouldn't start without understanding the basics of construction, right? Similarly, understanding the basics of investing is the foundation upon which you build your financial future. With a firm grasp of these basics, you can make informed investment decisions. So are you ready to start building? Let's continue on this journey towards financial freedom. Investing always involves some level of risk, but with the right strategies, you can manage these risks effectively. Let's delve into some risk management techniques that could be your shield in the exciting but unpredictable world of investing. First off, we come to diversification, a time-honored strategy that you might know as not putting all your eggs in one basket. By spreading your investments across different asset classes, sectors, and regions, you reduce the impact of a poor-performing investment on your overall portfolio. It's like a safety net, catching you when a particular investment stumbles. Next, let's talk about dollar-cost averaging. This strategy involves investing a fixed amount of money in a particular investment at regular intervals, regardless of the price. The beauty of this approach is that it eliminates the need to time the market. When prices are high, your fixed investment buys less, and when prices are low, it buys more. Over time, this can result in paying a lower average cost per share. Another strategy up our sleeve is setting a stop-loss order. This is an order placed with a broker to sell a security when it reaches a certain price. It's designed to limit an investor's loss on a security position. Think of it as your exit strategy, a way to tap out when the going gets tough, minimizing your losses. But remember, risk management is not about avoiding risk altogether. It's about understanding your risk tolerance, identifying potential risks, and using strategies to mitigate them. It's about making informed decisions that align with your investment goals and risk capacity. Lastly, let's not forget the role of continuous learning and staying updated with market trends. The world of investment is dynamic, and what worked yesterday might not work today. So arm yourself with knowledge, stay curious, and be ready to adapt. Remember, effective risk management can be the difference between success and failure in investing. Don't put all your eggs in one basket. This old saying holds true in investing as well. Indeed, the concept of portfolio diversification is a cornerstone strategy in the financial world. But what exactly does it entail? Simply put, portfolio diversification is the process of spreading your investments across a variety of asset classes, such as stocks, bonds, real estate, and commodities. The goal? to reduce risk and increase potential returns. Think of it like a well-balanced meal. You wouldn't just eat carrots for dinner, would you? No, you'd want a variety of food groups to ensure you're getting a balanced diet. The same principle applies to your investment portfolio. You see, different asset classes often perform differently under varying market conditions. When one asset class is down, another might be up. By diversifying your portfolio, you're not relying on a single asset class to drive your entire investment performance. This can help reduce the overall risk of your portfolio. But it's not just about risk reduction. Diversification can also enhance your potential for returns. While it's true that some investments carry higher risk than others, they also typically offer higher potential returns. By including a mix of low, medium, and high-risk investments in your portfolio, you're creating opportunities for significant growth. Now, let's be clear. Diversification doesn't guarantee profits or protect against loss in declining markets. And it's not a one-size-fits-all strategy. It should be tailored to your personal financial goals, risk tolerance, and investment horizon. So, how do you start diversifying your portfolio? Start by understanding your risk tolerance and financial goals. Then, conduct thorough research on different asset classes and their historical performance. Seek professional advice if needed, and remember, diversification is a long-term strategy. Diversification is indeed a simple yet powerful strategy to optimize your investment portfolio. By spreading your investments across various asset classes, you're not just mitigating risk, but also maximizing your potential for growth. So keep this principle in mind as you navigate your investment journey. After all, it's not about putting all your eggs in one basket, but about having a basket for every egg. Investing isn't a one-size-fits-all game. Your strategy should align with your financial goals and risk tolerance. Now let's delve into the fascinating world of long-term versus short-term investment strategies. Imagine long-term investing as the tortoise in Aesop's fable. It's slow, steady, and tends to win the race over time. This strategy is about buying and holding assets for several years, even decades. It's about weathering the storms of market volatility and sticking to your plan. The beauty of long-term investing lies in the power of compounding, which Albert Einstein famously called the eighth wonder of the world. Essentially, your earnings generate even more earnings over time. On the flip side, we have the hare, representing short-term trading. This strategy is all about making quick moves in the market, buying and selling securities within a single day, week, or a few months. Day trading and swing trading are common examples. Short-term trading can potentially offer higher returns in a short span, but it also comes with higher risk and requires more attention. So which approach should you choose? Well, that depends on your financial goals, risk appetite, and time commitment. If you're investing for retirement or your child's college fund, a long-term strategy may be more suitable. It allows your investments to grow and compound over time, generally leading to substantial gains in the long run. However, if you're looking to make a quick buck and you can stomach the risk, short-term trading could be your game. Just remember, it's not for the faint-hearted and requires a good understanding of market trends. In the end, both strategies have their pros and cons. Long-term investing offers potentially lower risk and less stress, but it requires patience. Short-term trading can be exciting and profitable, but it's also risky and time-consuming. Whether you're a long-term investor or a short-term trader, the key is to stay consistent with your strategy. And remember, every strategy should be tailored to your unique financial situation and goals. Investing isn't a sprint or a marathon, it's your journey towards financial freedom. In the dynamic world of investing, staying updated with the latest market trends is crucial. It's not just about buying low and selling high. It's about understanding the rhythm of the market, the ebb and flow of industries, and the pulse of consumer behavior. Imagine the market as a vast, living organism. It reacts to stimuli, emotions, and even global events. It's influenced by a multitude of factors, from shifting political landscapes to game-changing technological innovations. It's forever in motion, and as investors, we must learn to move with it. So, how does one stay updated with these ever-changing market trends? Here's where the beauty of the digital age comes in. The internet has made it easier than ever to access a wealth of information right at your fingertips. Financial news websites, investment blogs, online forums, and social media platforms can provide up-to-the-minute updates on market trends. Webinars, podcasts, and online courses offer insights from industry experts. Mobile apps can provide real-time notifications on market movements, ensuring you're always in the loop. But remember, not all information is created equal. It's important to discern between valuable insights and mere noise. Stick to reliable sources, cross-reference information, and always maintain a critical eye. And while it's important to stay updated, don't let the influx of information overwhelm you. It's not about tracking every single market fluctuation, but about understanding broader trends and patterns. Think of it like a compass guiding your investment journey. It helps you navigate the market seas, steer clear of stormy weather, and sail towards profitable shores. And lastly, staying updated isn't just about seeking opportunities. It's also about identifying risks. Market trends can signal impending downturns or industry disruptions. By keeping a watchful eye, you can adjust your sails accordingly, protecting your investments from potential pitfalls. Staying informed is not just about making profitable investments, but also about avoiding potential pitfalls. It's about sailing with confidence in the vast and dynamic sea of investing, armed with the most powerful tool of all, knowledge. Achieving financial freedom is a journey, and like any journey, it requires a destination. Now let's talk about setting financial independence goals. These goals are your lighthouse in the stormy sea of investment, guiding you towards a safe harbor of financial stability. The first step is to define what financial independence means to you. For some, it might mean the freedom to retire early, while for others it might mean the ability to make career choices without financial constraints. Once you've defined your destination, you can start plotting the course. It's important to set clear, achievable goals. Start by breaking your main goal into smaller, more manageable ones. For instance, if your goal is to accumulate $1 million in 20 years, break it down into yearly or even monthly targets. This makes the journey less daunting and gives you a clear roadmap to follow. Next, consider the investment strategies that align with your goals. If your goal is long-term wealth accumulation, a diversified portfolio of stocks and bonds might suit you. If you're after short-term gains, you might want to consider riskier investments like cryptocurrencies or high-growth stocks. Now, setting goals is one thing, but tracking them is another. Keeping track of your progress not only motivates you, but also helps you adjust your strategies if needed. There are plenty of tools available today that can help you monitor your investments and track your progress towards your financial independence goals. Lastly, remember that financial independence isn't a race. It's okay to adjust your goals as your circumstances change. The important thing is to stay committed to your journey and keep moving forward, one step at a time. With clear goals in sight, you're already on the path to financial freedom. So set your sails, hold onto your compass, and embark on the exciting journey towards financial independence. Together we can navigate the choppy waters of the investment sea and reach the shores of financial stability. Investing is a powerful tool to achieve financial freedom, but it's not a get-rich-quick scheme. It's a journey that requires patience, knowledge, and a well-thought-out strategy. We've explored several key areas in this journey today. We started with the basics of investing, understanding that it's the process of allocating resources, usually money, with the expectation of generating an income or profit. We've seen that knowing these fundamentals is the first step to becoming a successful investor. Next, we delved into risk management, learning that it's crucial to make informed decisions and mitigate risks. By understanding and managing risk, we can better navigate the often turbulent waters of the investment world. We then looked at portfolio diversification, exploring different asset classes, and the benefits of spreading our investments across them. This strategy helps to reduce risk and increase potential returns over time. Our discussion on long-term versus short-term investment strategies highlighted that there's no one-size-fits-all approach to investing. The best strategy is the one that aligns with your financial goals and risk tolerance. We also emphasized the importance of staying updated with market trends. Knowledge is power, and staying informed about market movements can give you the upper hand in making investment decisions. Finally, we touched on setting financial independence goals. Having clear, achievable targets can guide your investment decisions and keep you focused on your path to financial freedom. Remember, The journey to financial freedom is a marathon, not a sprint, so stay the course and you'll reap the rewards in due time.